Hey guys, it's Sasha. I don't often talk about my investing portfolios because it's just not a very interesting topic. It doesn't really teach people anything, it doesn't help you with anything, and I have my own priorities, I have my own reasons for the level and the type of investments I do, and everyone has their own as well. I know this is the sort of video that some channels seem to be doing 10 times a month on every single investment platform, how many shares they have and how many pence in dividends each of them earned in the last month, but I don't really want to be doing that kind of video. So instead, I thought that what I would do is I would sort of talk about my investing portfolio, but hopefully from an angle that would help you a little bit more by telling you some of the things that are really bad with it. So let's get right into it. First, let me quickly go through the portfolio overall. You will quickly notice some really big issues with it before I even get into any kind of detail. Now, the portfolio is split between 7 different accounts. Let me explain why that is. First, there are 2 separate ISA accounts. Both my wife and I have one each to make use of the £20,000 annual allowance, and both of these are with Trading 212 because they offer the best option, in my opinion, on price and features as it stands right now. Next, we have a regular invest account with Trading 212 as well, and that is sort of for a little bit extra for the overspill over and above the ISAs and for the ability to invest in things that aren't available within ISAs in the long term. Next, we also each have a Freetrade account. One really big reason is the fact that the Freetrade SIP pension is a phenomenal product, and that is one really good reason to actually do stuff with Freetrade. But I also love the platform. I really love what they stand for, and hopefully over the next few months they're going to be coming out with some major upgrades which will make me want to use the investment platform a lot more than I currently do. Last, I also have an eToro account. There are some things that I really like about eToro and some other things that I really do not like. I will be doing a deep dive review in the next few weeks. I need to wait for a few tests to come through, and make sure you watch out for that because I'm going to be telling you exactly what it is that I do and don't like about them. So the total sum of all of my portfolios is £51,000 or thereabouts. By the time the video comes out, it could be more, it could be less. About 41 out of those £51,000 is in those 2 ISAs that I mentioned, and the rest is split between the others. Now, I have a whole video where I talk about my specific investment strategy in the long term in a lot of detail. So if you're interested, make sure you go and check out that video that really explains why I make some of my choices. But having said that, the first thing that will jump at you when you go and look at my investment portfolios is the complete lack of balance and lack of adherence to the video that I just mentioned. I am miles away from the distribution that I want to have in my portfolio. For example, the first line, VUSA, which is my S&P 500 investment, sits at only about 7% of my total money. I want that to be much closer to 10%. But the next line is where it gets much worse. A ridiculous 55% of my portfolio is currently sitting in Tesla. That is a huge problem. I'm ridiculously overexposed on one company, shares in just one entity. And that is a really bad thing if you're investing. So that is the first big mistake. I personally have a huge risk tolerance, but even so, that is a ridiculous percentage to have in just one stock. The reason for me why I am in this position is I think Tesla is one of the most undervalued companies in the market out of the big ones today. I'll be releasing a detailed video in a few hours time, hopefully, why my Tesla valuation is what it is, exactly how I arrived at it. I'll show you the actual model that I've used, and I'll explain all of that in a lot of detail. However, I also feel the market is way off at the moment, and as a result, I've gone and plonked a ton of money into Tesla over the recent period when the price collapsed. Now, the next big problem you may notice is that I am not using specific platform advantages in deciding how to use them. I actually talked about this in a separate video, so you might think, hey, Sasha tells one thing in the videos, but does something different himself. And you would be kind of right. You see, for example, I have a Tesla share on eToro, which actually cost me more to buy and sell than if I went and bought it on Trading 212, for example. And I also have US stocks on Freetrade, which is much more expensive than being able to buy them somewhere else. I also don't have a single UK big company stock on my eToro portfolio, despite it being the cheapest place to buy big UK companies because you don't have to pay stamp duty. So you can notice all of these things. By the way, if you do want to go and sign up with eToro to make use of some of this, being able to buy UK companies, make sure you use my link in the description below, which will give you absolutely nothing, but I'll get a little bit of commission for referring you their way. So thank you very much in advance. But anyway, there are a couple of reasons here the amount of money in these different portfolios that I have is pretty low. So I've not really been optimizing them because that's not been the focus of my attention. Also, I made a few videos where I introduced these platforms. I kind of did an introduction of how you go and set up the account with them for the very first time. And in those videos, I showed you how you go and buy some of the initial stocks. And that's how I bought some of these. And it doesn't make any sense to sell them now that I've bought them, even though I didn't buy them at a good price, even though they cost me more than they would elsewhere. I just decided to go and let them sit there for now. Now, the next big problem with my portfolio is sort of linked, but somewhat separate. It is diversification. You'll notice almost all of my portfolio is based on tech. There are really good reasons for it. Tech is where I see huge opportunity for growth over the next decade. And I think some of the companies that are in this space that I'm invested in will grow with tech as well. But they are subject to a huge amount of volatility, a lot more than some other companies. And in the long term, a crash or a correction that is specifically focused on tech, like for example, what we had with the dot-com boom, could really wipe me out. So I do need to sort that out, and I will be sorting that out over time. Another issue that I have is that I carry about 3% of my investments in Bitcoin. Now, this is one where some people watching might divide their opinion, because some younger people might be thinking, hey, that's way too low. You basically don't have anything invested in Bitcoin. I know there's a massive trend where people have huge proportions of their investments in crypto. By the way, if you want to invest in crypto, I use eToro, so make sure you use my link in the description below if you're interested. That's a place where you can invest in crypto at the same time. But for me, and some people may agree with me, maybe, I feel that 3% is actually maybe a little bit high. The volatility and risk associated with Bitcoin is really different to holding shares in companies or holding ETFs. And I appreciate that the potential is huge. I really do. But at the same time, the lack of being able to predict the path, or the lack of being able to understand the future regulatory environment, or millions of other things that may impact the price of Bitcoin or any other crypto, means that I don't really want to overexpose on that front. Unlike something like Tesla, I can't go and build a model that accurately goes and says why it's worth what it's worth, why I think it should be worth something else, because unfortunately the majority of the current price realistically is based on essentially market hype. And although that in itself is not a bad thing, it means that I can't really go and say what I think the value of it really should be, other than plucking numbers out of thin air. So what I don't want is to go and invest heavily and then it go crash and do something similar to the dot-com bubble. So anyway, if you scroll right to the bottom of this list, you'll notice that I am carrying a grand total of £6 in cash. In fact, I've actually just added about £30 to this because I received a few dividends over the weekend, but the fact is I carry almost no cash in my investing portfolios. This means that if there was a big crash or a correction or a sell-off in another industry, I don't have any money to buy the dip, and that some people will say is a big problem. To me, it really isn't. My investing portfolios had about £12,000 in them at the beginning of February. Once the big tech sell-off happened, the price of some of the companies that I really wanted to invest in for the long term collapsed, and I went and liquidated a bunch of other assets I held. I pulled money out of my business, and I added about £38,000 to those portfolios over the last 2 months. So in effect, I do kind of have cash available, I guess. It just doesn't sit there as cash in a bank account or in my investing portfolio or somewhere like that. And given the big sell-off, I've essentially already deployed that cash to work right now. So hopefully it will be doing something good in the long term. Now, I hope you guys found this useful. If you have, don't forget to hit that like button for the YouTube algorithm so that this video can reach more people. Thank you so much for watching. I really appreciate it. And as always, I will see you guys later.